Well, hi everyone, and welcome once again to Feeling Smarter. As always, I'm joined by my co-host, Tim Miller. Welcome, Tim.
Aaron, always a pleasure.
We are continuing this journey of Division 296. It is front and centre of a lot of the conversations that we are having, and today we're going to move the needle towards the decisions of making a CGT election. It is important to note it's not a cost-based reset, it's an adjustment that we have, and that might be the first question that I pose at you here. Why is that an important distinction?
Yeah, look, it's important because primarily we're not talking about a fund tax, right? So we're talking about a tax on the individual, and it's a tax on the individual on earnings that have been generated post 2000 or the 1st of July 2026, and so we don't want to reset the cost base of the assets that belong within the super fund, but we want to recognise the earnings that are attributable to an individual from 1 July 2026. And so by making an adjustment to the cost base of the assets that the fund holds, we're only recognising any growth that will occur from 1 July 2026 until the disposal of the asset.
Yeah. So a common question that we're getting asked is whether the ability to make this CGT election is only allowed by in-scope members, or B, is only attributable to funds that ultimately have in-scope members. So I guess provide some context around that and then expand on why it may be more relevant and more broader than what people are ordinarily thinking.
Yeah, so I guess if we take a look at this purely from a legislative point of view, where they say, well, DIB 296 only applies to individuals with more than $3 million, right? So therefore, that's our first place that we go to in our mindset. We go, well, it's only applicable there, so we're really only targeting funds with these large balances, right?
Yep.
And so therefore, it's important to look at the gains for those funds. However, when we take a step back, and we look at it and say, well, what we don't know is, we do know that there is indexation, so we know that the thresholds will go up. What we don't know is how many people in the future will be in scope for Division 296 purposes. And so, this adjustment for 30 June 26 valuations for CGT purposes ultimately is something that should be looked at by all funds, right? Whether they do it or not is a different story, but all funds should be contemplating it, primarily because any gain that they might have from inception to 30 June 2026, if they do the CGT adjustment, then those gains will be ignored, and it will only be any gains from that point in time onwards.
Yeah, and so that is a really important distinction because, of course, we had the 1 July 2017 point in time where the CGT reset was done for transfer balance cap purposes. And there are situations for some funds where they have recognised a deferred tax liability that needs to be accounted for on disposal. So how do we need to understand the differences between the Division 296 election or CGT election that will adjust and whether it has any parallels to the CGT reset back in 2017?
Yeah, so I think the first way to look at that is it has zero parallels with what happened back in 2017, because 2017 was a superannuation taxation situation, right? So we were looking at moving funds from an ECPI environment to an accumulation environment to reflect the introduction of the transfer balance cap, and so that impacted the taxation position of the fund, right? What we're doing here is we're looking exclusively for DIB 296 purposes at the earnings attributable to individuals with high balances. So any calculation to do with Division 296 has zero implication on the calculation of tax for a self-managed superannuation fund. So things like the deferred tax liability from 2017 is an exclusion to Division 296 because that's a previous tax liability that's been raised. So, it's very important that we distinguish between super reform directed at super funds, i.e. 2017, and super reform directed at high balance individuals, i.e. Division 296, and that they have vastly different calculations, but they ultimately look at the same asset pool.
Yep. And as we go through these calculations and decisions that need to be made, we've already highlighted the fact that we need to be looking at assets that effectively exist on the balance sheet of these self-managed super funds at the 30th of June 2026. Now, we have some important criteria in making that election that we need to be aware of. So can I get you to expand on what those key criteria are, and then what impact does it have in terms of which SMSF return it's all relating to as well?
Yeah, so there's a couple of things that I'd sort of touch on in regards to that. The first one being that the adjustment doesn't apply to indirectly held assets. Right? So one thing that we need to take into consideration is that if you've got indirectly held assets, such as an investment held via a trust, albeit there's an exclusion for LRBA assets, right? Because that's a bare trust arrangement. If we've got an investment in, say, a pre-99 unit trust or a 1322C unit trust or company, then you can make an adjustment to the units or to the shares in those investments.
As being directly held?
Yep, but not the underlying investment. So you might have a property that was purchased many years ago. That cost base of that property is not being adjusted. So that has CGT implications that we need to be mindful of there. So that's one of the key things to take on board. The thing about lodgement is that we're looking at the investments exclusively at the 30th of June 2026, right? But it's an election that we have to make by the due date of the lodgement for the 26-27 financial year SMSF annual return. So you've got to look at whatever your lodgement date is there. You know, if you're not with a tax agent, you've got a lodgement date in October, November, whatever the period might be around that point in time, or you might have the extended date to May or June, subject to being nil taxpayer. So there's various things to contemplate, but it's that lodgement date by which the election must be made. But the election is not something that gets sent on to the ATO. So it's something that needs to be maintained within the fund's records, right? And then utilised if necessary at any point in the future, you know, when you potentially become liable for DIP 296.
So I think the important parts that we want to ensure people understand, and this is a distinction from obviously the 2017 reforms where you had the capacity to kind of pick and choose assets, right? So we can all assets. So it's one in, all in. So you need to understand and analyse some might be in a gain position, some might be in a loss position. So that distinction that you make between the gains and losses is something that needs to be applied universally across those. That decision, once it's been made, is irrevocable as well. So there are a number of things within here that we need to ensure we understand, and then there are a number of other sort of documentation requirements that need to be included within the evidence to show that decision has ultimately been made.
Yeah, that's correct. And I think you make a good point, especially around things like losses, right? Because the fund might not be in a loss point of view it might be in a loss point of view from a CGT position right now, but ultimately that means it's going to be in a larger gain position potentially for DIP 296. So, you know, understanding the differences between the fund liability versus DIP 296 is really important.
Yeah, absolutely. And we at Smarter SMSF are naturally going to do a lot of work around the documentation that will be required for the CGT election as well. So be on the lookout for that. It will be part of our Division 296 Tax Hub on the Smarter SMSF platform. But Tim, thanks for your time.
Always a pleasure, Aaron.
We'll see you next week. Bye for now.
See you.